This is the presentation titled The Final Accounting Part 1, and it is given for the PLA 2600 Wills, Trusts, and Estate Administration course taught by Suzanne Bechtel at State College of Florida, Manatee, Sarasota. After reviewing the presentation, the student will be able to explain the times an accounting is required, explain the final accounting period, identify the format of a final accounting, describe the schedules included in a final accounting, and recognize the types of transactions that are included on each of the schedules to the final accounting. We're going to briefly go through this final accounting and what it is generally, the generalities in Part 1, and then in Part 2 you'll actually be working on a final accounting. First, we need to know when is an accounting required. An accounting of the estate, that is required upon the resignation or removal of a personal representative, at the conclusion of the estate, or the court may require, or the personal representative may elect to file an interim accounting. What period of time is covered in the accounting? The first accounting by the personal representative will cover all the transactions, the financial transactions that have taken place in the estate for the time period beginning with the inventory. Since there is no requirement, as mentioned earlier, of an interim accounting, it's possible that the first accounting will be the final accounting. And we call it the final accounting because in this case, for our case scenario, we are concluding an estate, and the law provides that it needs to have a final accounting. What type of form is used for a final accounting? The format of a final accounting is the same as that for a fiduciary accounting. A fiduciary accounting is a form prepared by a fiduciary, and in the case of a will, an estate that is, a personal representative is a fiduciary. As a result, the fiduciary will prepare a final accounting to explain everything that happened in the estate and describe the transactions that affected the estate as a whole. The content of the final accounting, it includes a summary. The summary is the last item that's prepared, but it's the first item in the accounting. So it's necessary to realize that after preparing what we're going to look at in the schedules, then you prepare the summary. Schedule A is an example of the schedule that reflects the items received during administration. So during the administration of the estate, if new property is recognized that wasn't recognized before in the inventory, or money is received, that's the best example, we would list that money received in Schedule A, so long as it's not also scheduled in the inventory. So anything that is a receipt would be reflected on Schedule A. Schedule B will reflect the items paid out during the accounting period. The items paid out might be items for creditor payments, funeral expense, basically any kind of disbursement, not to beneficiaries, but disbursements in the administration of the estate would be listed on Schedule B. Schedule C will reflect the items and the amounts, or the amounts distributed. Distributions is what Schedule C covers, and distributions are items and amounts distributed to beneficiaries during the accounting period. So it differs, C from B, differ because distributions are items going to beneficiaries, and B, Schedule B is disbursements not to beneficiaries. Schedule D is called Capital Transactions and Adjustments. It reflects all purchases and sales of assets and any adjustments to the carrying values of any assets. Now, what's meant by carrying values is, for example, the inventory. The inventory is the final amount in the inventory, the total of all property. That's the carrying value of the estate. But if, for example, a car is listed for $4,000 in the inventory, the carrying value would go in, would not need to be reflected in Schedule D. So it's the carrying value of the estates that are their purchases and sales of assets since that time, since the inventory. Schedule E is a complete list of all assets on hand. So at the end of the day, there is going to be a sum of money that's available, or other assets, could be physical, personal property, or real property that's on hand at the close of the accounting period. Now we have to use a form for this, and there's a model format for an accounting that is included in the Florida Probate Rules, and that's in Appendix A of the Florida Probate Rules. Next, we're going to look very briefly at a form. The form that I was explaining is available in Appendix A. And I don't want to spend a lot of time on it. We're going to work, I'm going to describe it for you, but we're going to work on it together for the Cynthia Porter estate in Part 2. So the objective now is to simply look at the form and see what we can learn from looking at the form. The purpose of the accounting is, to let people know what the transactions have occurred during the period covered in the accounting, what the assets are like, what's left of them, what's been sold, what's been added, and it is available for to be reviewed by anyone that receives it, and the personal representative attests to verifies the accuracy of the accounting and the amounts in the accounting, because of course a personal representative is a fiduciary. All right. Each item in the account, each page of the accounting, by the way, has this from and through date. In most cases, in an estate like the one we did for Ms. Porter, we would have the from date would be the last date, the date of the inventory, and the through date would be the date that the estate is being closed, the date you're preparing the document, basically. It's not the final, you fill it out last, because it summarizes, just as the name would imply, all of the schedules that you're preparing in this accounting. So we save it for last. Schedule A, receipts. And again, notice the trend, the from and through date. This will be consistent on every page of the accounting. The date is listed along with the description, and then, as we're going to talk about, you have to decide if the transaction, the receipt, and remember, receipts in Schedule A, those are items received during the administration of the estate. You describe it, and you decide through the Principal and Income Act, which is Chapter 738 of the Florida statutes, if the transaction affected income or principal, and in each case, any transactions would all be listed. That decision would be made for each transaction, and then this column is totaled, and this column is totaled. Schedule B, disbursements. Remember, disbursements, that reflects only the items paid out during the accounting period. And again, the consistent approach here, the same dates will be here as you had on the first 2 pages we've already looked at. Disbursements, again, only those items paid out during the accounting period. The date would be listed, a description of the disbursements, whether the disbursement affected the income of the estate or the principal. And again, that's something that you could learn by knowing more about Chapter 738, the Principal and Income Act. I'm going to walk you through it because that's one of the things that isn't clear without some guidance. Then again, these items are totaled. One might be a total amount, one might be 0. So the totals go here in dollar amounts. Schedule C, distributions. Remember, Schedule C reflects only the items or amounts distributed to beneficiaries during the accounting period. So assets, we're going to have their carrying values that we're going to use unless there was a reason to change that. We'll have an example in the case scenario we have. But again, the dates of each distribution go here, descriptions here, and you, using the Principal and Income Act, determine which of is it an income transaction or a principal transaction. Total those up, and again, these totals that we're coming up with will go into the summary. Schedule D. Now Schedule D looks a little bit different. You can see it's a little less, it doesn't first of all have principal, income or principal. Instead it has gains and losses. That's why with Schedule D we use that for capital transactions and adjustments. So if the value, for example, that I've listed in an inventory of an asset, let's say the item sold for $100 less than I listed in the inventory, that would be a capital transaction, not to be just confused with a distribution to a beneficiary that goes to Schedule C. So it's possible you might have something that's listed in distributions as well as capital transactions. Alright, because it might, if an item was inventoried at $10,000, and say it's an asset like a car, and the car was sold for $9,000, that affects the net value of the estate, and it's a distribution. So in some cases you might see an item that goes on more than one schedule. The standard operation of listing the date the item is of the transaction, where you adjust the value of the item. That's what we mean by adjusting the value. Showing a loss, perhaps that money that the car, it was worth $1,000 less than it was listed on the inventory. That would be a loss. And then there's a gain, a description of the transaction and the date. And then down here you would total them again and recall that the reason this is in parentheses is if it's a loss, if your total net loss would be a subtraction to the estate, so it needs to be represented here in parentheses. And sometimes there's a higher gain than there is loss, or a higher loss than there is a gain, and as a result we would reflect that. If it's a gain, it would be reflected without parentheses. If it's a loss, it would be reflected with parentheses. Moving on, and again we're just trying to get used to the form here, kind of get some fill in the ideas here. Again, same standard of the date, the same on every page. And now we come to Schedule E, where we're listing all the assets on hand at the close of the accounting period. Now, most of the time it's cash. Whatever is left is usually cash. Sometimes there is a piece of property, or 2 or 3 or 4, that will be distributed, as we call it, in kind to beneficiaries. Meaning, let's say we have $10,000 cash and that's how much it's worth today. When it's all said and done, we have $10,000 cash left over. It didn't go to anybody at all, didn't get paid to creditors, it's just leftover money. And as a result, there's 10,000 that we have one beneficiary, and that beneficiary is going to get all of that $10,000. Or let's say we have $10,000 cash, and we still have a piece of real property. For example, a ranch. The Yosemite Sam's ranch couldn't get sold. We couldn't find a good buyer for it. And there are two beneficiaries. So we're going to distribute that in kind to the beneficiaries. Most of the time, though, I will say that this tends to be cash only. Again, we come up with the total amount, and the item 6 on the summary will be the same as what's left here. So that should make sense. Schedule E is basically what is left over to get rid of. What do beneficiaries need to get? And this is what Schedule E is for. The last page of the final accounting form is basically, in fact, I've had it in front of me printed as I've talked to you about the schedules and the summary, and pretty much was able to read off of some of these things, this list of items, and they're just some very general instructions. And again, these general instructions do not include, as I pointed out, Chapter 738 of the Florida Statutes, which is pages and pages long of the Uniform Principal and Income Act, that really describes whether an item should be classified as income or principal, or, and again, here's another example, principal and income, Chapter 738. So while we're filling this out in the real world, which I won't be having you do for this assignment that we're going to do in Part 2, you're really referring to the Principal and Income Act to determine how to schedule in those two columns, income or principal. And that's just something that we're not going to be covering in this class, but it is something you need to know exists if you're ever doing this on your own. Alright, so what's the next step? The next step is we've just concluded Part 1, Presentation on Final Accountings, where you had a chance to sort of get to know what an accounting is going to look like, what's included in it. The next step is to proceed to the Part 2 presentation, which is a separate presentation. For Part 2, you need to have these materials available to you. I'll remind you at the beginning of Part 2, but if you want to start gathering them up now, in the course, online course, there's a blank financial accounting form that I've provided to you. It looks just like the form we just went through here. And so if you would go into the course and find that, that would be great. There's also a spreadsheet that describes the Cynthia Porter estate. The first part of the spreadsheet has a list of checking account transactions, and it's clearly labeled checking account, and it looks like a ledger with descriptions and amounts. And the other part of it is a listing of the distributions made